Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results.
So stressful. When the world's on fire. Good God. I can't look at this, guys. Like, my strategy is you buy it and you hope that you got a good spot. Yeah, but we all think you're crazy. You don't fight this. No way. The markets are freaking out and you don't think that anything is wrong? Come back tomorrow and I'll lose it all. Should be fun. Good morning, everybody. I almost didn't get the mic, so I got the new microphone stand from Elgato, and the switch is kind of in, I can position it so much better now, though. But that's not the point. Today we have a CME webinar for the micro treasury futures, so we're going to enjoy that. And market is doing some interesting stuff. So let's go to the charts. Yesterday. Wait, where? Where? Here we go, volume profile. Okay. So yesterday, we had a move down. It wasn't like too dramatic. It wasn't quite like this overnight per se, but it was a standard deviation move lower. Now, overnight market tried to recover, and now here more recently we're getting another push down. I don't know if that's due to news, but it's looking pretty good downside. But hey, maybe today is buy the dip day. I don't know. I get a little concerned when I start to see like slow and steady declines, and then if today were to be another slow and steady decline, that's when I start to get a little concerned, right? Here, the treasuries yesterday were just insane. I mean, we had a pretty good up move, but like even after I left, like look at how much further it went after we left. That's crazy. So we continue to ask, is this just because of the reverse repo and what the Federal Reserve is doing that's creating demand for treasuries? I'm not so sure anymore. At what point do you have to say there's something else and they're pricing in the recovery faltering of some sort, right? All right, over here in oil taking another downer day. So there aren't any significant headlines that I have seen in the oil markets. I think that this is more macroeconomic related, but that's maybe worth investigating a little bit. Gold and silver still kind of sitting here, though. Gold and silver still kind of sitting here. So it seems like, copper's going down, right? And then the dollar's been weakening here. Okay, so I'll reduce that. So here's the thing: is like, when does it become like, how do I say this? When is it like no longer just the economy, right? That's kind of the thing. Is like there's so normally I would look at the treasuries and I would say, are treasuries pricing in some probability of a recession or pullback in equities, whatever, right? And when I look at the treasuries, I kind of say, well, I don't think that that's the case, because one, it's like the way it's behaving is just kind of a little weird. It kind of comes out of nowhere, and it seems like it's more demand related to me. But then when I'm starting to look at the rest of the complex, I'm seeing oil down, I'm seeing copper down, and those would all seem to be indications of the economy not doing so well. And therefore, the Federal Reserve needing to keep rates because the economy is not doing so well, right? I don't know. And then you go and you look at gold and silver, and gold and silver are not moving up because they seem to be thinking inflation must not actually be a thing. I don't know, or maybe they're being kept down. But I think that the way gold and silver are acting right now, kind of a little bit out of sync with everything else, yeah? So, interesting, trying to sort out what's going on over there. So, Yes, at 10 o'clock, there is going to be a CME webinar on the micro treasury futures. I'm going to be really interested what they talk about. What else? I think that's it. Well, so I'm looking at the microphone, and the whole thing is it should be there. Like that's where I decided I want it to be normally. I don't know, but I can move it in. Like I can move it in real close. Maybe I should keep it there. What else? Okay, I think I want to turn on some robots, right? So this, first of all, I will turn this one on even though it's just like not really working. Then there's this other one that I made yesterday that it backtests really well, but it doesn't take very many trades. Maybe it takes a trade a day. But I really like it, actually. Like the whole concept is very good. I like it. One sim. I'm just going to go in and I'm going to let it, though. I'm going to let it take 2 entries per direction. That should give it a little bit, few more trades. Because I tried it, I was like, well, here's one way of doing it that seems to work, and here's another way of doing it that seems to work. If I combine them together, I should just get twice as many trades, right? Nope, didn't quite. The overall performance of the system when both of them wasn't as good as it should have been. So now I'm thinking, well, maybe it's because they overlap too much, which actually gets really interesting. But here's the crazy thing, is that it's like, it ends up being a buy. So like, is it really that good? Or is it just picking up on the market goes up? Because the problem with this one is that I can only backtest a year's worth of data. I have no clue what you're talking about, Alan. Okay, let's turn on the text to speech here. Oh, now we do have some numbers today, right? Factory orders. Factory orders month over month, June. Well, I think I'm going to move the microphone over just a little bit here. Still kind of adjusting it, and I'm sure I will zero in on the perfect spot, but the perfect spot is not where it was at. Alan says, "Never mind, it's a different stream, but nice to see a stream I'm not lost in." Well, hey man, if you if this is your first, well, I mean, I've never seen your name before, so this is your first time on this stream, and me going through all that did not have you lost, then you are in the right place, my friend. Do you cover the meme stocks? Not usually. So, when the GameStop thing happened, we followed it and we talked about it, and we had a ton of people visit the stream because of that. But generally speaking, I'm not too interested in day trading stocks. There's a lot of things about like the wash trading rules and all of that I think make stocks not a very optimal vehicle for day trading. Good morning, WineTube. It's early morning when getting under the desk and then getting back up has got me out of breath. Do you trade futures, options? I don't. I think that is something that I would be really interested to get into, but I also feel like that to really do options effectively, that I would need a pretty big bankroll. So now that they're going to be introducing these micro treasury futures, and if we get options for those, then it might become a good option. So then I'll probably look more into it. I think that options is a place where you can make money. Is just, for me, it's a little too rich. So I don't really like risking very much capital on day trading because, it's hard and you usually don't make money, right? Be under no illusions. Day trading is one of the most difficult things that you can do, and you'll probably lose money. Let's see here. Turn on the text to speech here. So I feel like I'm missing something. Oh yeah, so I was looking through the news here. So we do get factory orders today, and New York Fed Treasury purchases 10 to 25 years. That would be an important thing to note. That might be part of why the treasuries seem to be just like they want to buy. Also, Alan, don't be shy about asking questions, because that's the whole thing. Show us how you make your money. Well, I do have a day job, just letting you know. So one of the things that we do here, because a lot of streams will be like, I'm making so much money, guys, gotta watch me because I made a bazillion dollars today. And if they really made that money on live accounts, then that's their thing. But I don't ever want to present this impression that like my results, if I'm doing well, that my results can be duplicated by you, like there's always a huge risk in futures trading, right? And that needs to be presented first. I think I woke up a little dehydrated here. Options is complex to learn, but you can trade it in different ways with options rather than a stock. Well, yeah, exactly. Like the thing that I like about stock options from the perspective of, a retail trader that just owns a stock, is that I can set up complicated strategies based on exactly what it is that I think is going to happen or the risk that I want to protect myself against. But if I was going to like day trade options, I think that I would want to be selling them. And yeah, I would probably need like 100K to do that. And I ain't that rich. Nope. I will stick to my, few dollars a day. That's fine. And I have a day job. I do programming. So actually it's called site reliability engineering, which is a big topic these days. But man, they are just, so the thing is I'm not sure that I could just up and buy it, like even at 0.5. Definitely not at 0.1. It would be a little sketchy, but they sure look like they want to go up. We should be careful though. They've done this a few times. Like yesterday, remember they went up and they came all the way back down and then they went up and then it went, they've kind of been messing with us like that, being tricksy about it. Why not invest in options on S&P 500? Well, I don't know. Like here's another thing. In this market environment, why do anything other than be long the S&P 500? Like the thing is I come in and I can scalp, right? And I can see, okay, I want it to go 16 ticks in my favor before it goes 16 ticks against me. Where's the situation where I can grab that, well, it's super hard, right? Or I could just be long the S&P 500 all the time. Because the thing is, even if I'm scalping and I'm doing it really, really well, I would have to scalp like every little trough to make as much as if you were just holding long, So until the market becomes a little bit more mixed, and maybe that's happening, like we said in the beginning, some of the commodities and stuff kind of suggest a changing macro framework here. And when things are going short in the S&P 500, then it very much makes sense to day trade it and go short, right? But when it's just bubble up all of the time, I don't really feel like it's worth it to put on the risk. I think that you're better off just staying long shares, and getting your 20%. Because like you get 20% in a year, like that's really good. And that's what it's been doing. Like it did that during the whole Trump years, right? We could, like, from when Donald Trump was inaugurated to the pre-2020 peak, it was like a 20% gain per year, And then there was a pandemic, of course, but then after the pandemic, you've made like a huge amount too, right? So in that environment, why not just be long? Because you're not going to make 20% a year on your whole money trading futures. Probably it's super hard, right? Okay, Noah Christian says, is it possible to make a robot using the time in sales? I'm new to coding. Yeah, you absolutely can. So I think that what you're saying is the way that NinjaTrader splits it out, there's three major methods, right? There's on bar closed, which is like when a candle finishes. There is on market data, which is every time that it gets a new order that comes in. And there is on market data, which is when the level 2 changes, right? So you can trigger changes and set your robot up to do things based on all of those things. Now, only using the times and sales, what would your robot do? Because like the best that you could do is if I see a large order, follow it or something like that, right? But could you incorporate that sort of thing into your robot? You absolutely could. Ian McCormick, hey, it's been a while. I remember that name. I'm seeing a lot. It's kind of weird because a couple of new names in chat today, but it's the same number of concurrent viewers. So this is kind of funny. It's like I don't know how YouTube does it, but it's like YouTube says, okay, we want Seth to have 12 viewers, and if he's not at 12 viewers, then we're going to show it in some of his followers' feeds. But then once we have 12 concurrent viewers, that's it. That's all he's allowed to get. It's so weird. Well, I wouldn't call it a hypothesis. I that's just the cynic in me talking. But that's the way it's been for a while. Like when the summer came along, there's always a drop of numbers in the summer, but it's come down to, early morning we have about 12, and then later on we get about 24 to 30. Whereas before it was like early morning we'd have 20, and then when the e-mini started going, we'd have like 50. I think all platforms do that. Like if followers or viewers fall off, they put you at the top of suggested until you have the same. Maybe. Like the thing is there's definitely something to like when it decides to show me to people and when it doesn't. Like when it was the GME thing and I put GameStop in my title and I was getting thousands of viewers, and then they all disappeared. And I'm sitting there and I'm like trying to sort out, how is that possible? Is it because I'm just really boring and the content that I present is just not interesting to the vast majority of stock traders? That is a really likely possibility, actually. Right? So...
Order canceled.
They are. I turned them on. Did you just hear that little... It tried to submit an order.
Submitted.
Okay. It tried to submit a position, and it didn't like where it was getting, so it tried it again. That's interesting. Oh, what? Stick. I was short crude yesterday and was holding that short over the entire weekend since Friday, and it closed on the tiniest bounce up right after the initial... Oh, man. But what was your initial thesis on going short? Because I'm kind of looking at oil today. It's down over $1 now. And I'm like, why? You tend to keep doing you, and the folks who are interested will find it one way or another. Yeah, I think so too, Al. Like, the thing is about this stream is when we had the GameStop thing and there was like 1,000 people, like it was fun, but after 2 days of that, I was like, okay, we got to get back to our usual thing, So like I kind of intentionally dropped it. So to me, it's not really important that this stream has 1,000 followers. What is important to me though is like, if we're getting 50 followers and then all of a sudden we go to 20 followers because they're not finding the content interesting anymore or useful anymore, then that's a problem, right? But we're more interested in serving our core audience, right? And the core audience is probably never going to be huge, because people just aren't going to be that interested in interest rates, I have some August 20 gold and silver calls. Oh man. Well, I tell you what, man, I'm finding the metals trade to be really frustrating. So I bought some silver. It's not a huge position, but I bought some silver on the expectation that when we got the inflation later in the year, which we did get, by the way, that gold and silver would go up. But the problem is that the most, what is the word? The most influential thing for the treasuries for gold and silver, is what interest rates are. So when interest rates increase because they're concerned about inflation, gold and silver go down. And so gold and silver don't end up being the hedge against inflation that it's supposed to be. And then when the treasuries go to like record low yields, gold and silver don't move up. Like, what the actual, how? It's like no matter what happens, you lose over there. And everybody, and then it's hard to sort that out with, everybody says, oh, gold and silver are just being manipulated by the banks. And I'm like, well, that's not a very good, explanation. But I have a really hard time coming up with another explanation for how it's behaving. You know what I mean? So it's a good thing that the silver was a small position, because it was down like 20%, I think. Yeah, I think it was down 20%, which was only like $20, but still. I'm really frustrated about it. Worse than zero sum, everybody lose. Yeah. Well, now the thing is, though, is when I look at what's going on here, I think that we're getting some markets that are very much offsides. So like the treasuries, when this first started moving up, I think that the theory that it was mostly position made a lot of sense. There was a lot of people short the treasuries, and the whole reverse repo thing and everything was creating demand for them. So I think that like a squeeze made sense. And when you see how far this has gone, you can, that's just a great example of what happens when these markets get out of sync, right? Excuse me, I'm having like my stomach is, there we go. My digestive system is still messed up from that flu I had over the weekend, I think. Anyways, so what do you think is going to happen if this flips back around? Like I think right now the market is saying, we're worried about lockdowns, and if it's not lockdowns, we're worried that the supply side constraints are going to have a huge impact, or well, not huge, but they're going to continue to have a large impact. And since peak growth is behind us, it's going to be difficult trading. Like that's what I think that they're saying, and when these things flip around, they could flip around really hard. If we get a good jobs number on Friday, for instance, comes out, million jobs created, it's above consensus expectation. Like if we had a positive jobs report, think about how hard the 10-year treasury could drop, right? It was like I woke up one day and reverse repos had doubled overnight to $1 trillion. Yeah. The reverse repo thing is kind of starting to get weird. So the thing is that when it first started to happen, again, it was like it made sense. They're coming into like some end of quarter stuff and all of these other reasons why they're going to need to have a lot of collateral. And so that's why they're doing the reverse repo, right? And I think that was correct, because after that, it did decline. But then it came right back up to $1 trillion just like that for no reason. For no reason, really. Like nothing changed. The rates decreased. So it's kind of getting a little weird, right? Because it should have gone away by now. And I thought, okay, they're offering 5 basis points, then the rest of the market, short-term lending market, should come up and also start doing that too, right? Like, wasn't that the intention of that change? But I think the opposite happened. I think that because everybody could go and get the 5 basis points at the Federal Reserve, the other market participants like didn't even bother. They're like, well, I can't compete with the Federal Reserve, so, you know. Thank you, Win. Please hit the like button. We shoot for 20 likes. Well, yeah, if we get 20, that's a good day, isn't it? Stick says, you know what, Seth? I notice that I'm often being too early to a trade. I'm early to trades a lot too, though, Stick. It's really frustrating, isn't it? I mean, too early to a crash or a rally. Yeah, well, I think that kind of what can happen to you is you might have a fundamental theory about why something is going to go somewhere, and your overarching theory is right, but the flow isn't with it, or like, you know, you I don't know, like they do stuff to try and scare you out of it first before you go in. Yeah, I take them off just before they go. Yeah, so I'll give you an example. Remember this whole thing about market impact? Well, that's a review for the new people. There is a square root law of market impact that says that normally people think if I trade, you know, that's too thick of a line. Most people think if I come in and I trade 1,000, 2,000, 10,000 contracts. So if I move 1,000 contracts and it moves it up this much, then if I move 2,000 contracts, it should move it up twice as much. And if I trade 10,000 contracts, it should move it up 10 times as much. I need to have a linear impact. But the reality is that there is like an upper limit on how much impact you have. So at first it's linear, but then it trails off and there's like an upper limit. And this is the square root law. C times the square root Q over V. Okay. And this happens because of the limit order book. Another thing that happens because of the limit order book is that when you get a strong move, there is a liquidity hole left behind. So because of that, you get the inverse sine law, which says that if I were to trade 10,000 contracts, but I were to sell them at this point, that my impact would actually be higher. Like that. Right? This is the impact that you would have off of 10,000 contracts, negative 10,000 contracts, right? Okay. So you will often see moves like this. So it's coming along and then it kind of trails off like that. That's the square root law, right? But then, like, if somebody came in and did the opposite way, then it could go like this, right? And you get this sort of a thing. So if you really wanted to manipulate the price of something, that is, so because of this, you got to be careful, because if you just straight up buy something and then straight up sell it, you're going to lose money, right? But what you can do is you can also use this to move to create momentum for yourself, right? So if you're willing to spend some money and you really want to take an aggressive trade, you can use this to flip things in your favor. So you can come in here and you can, like, over a long period, over days, you can go short here, right? And then you can come in and buy back a little bit of your position so that it moves up like this, right? And then once you've created that wake, you come in and you immediately buy, if you're going short, right? Buy back a little bit of your position and then go short again. And you should get this. And then hopefully that should create the momentum that it'll start doing this, right? For you, right? So here, you've spent money, you've lost this. But if that creates a real wave of selling and it goes 3, 4, 5 times that, then it ends up being worth it. So sometimes you may get into the trade and you're doing it for a fundamental reason, and then it starts going up and you get scared out, and then they go and they do it. And I think that that's how that happens a lot of the time.
Target filled.
Oh, good. My robot made money. I would be really happy if that had been on the Combine account. I told him though that I don't want to do it for a second month. I wanted to keep it to 1 month. I don't actually want to be funded. like I thought about it. I was like, well, if I get funded, shouldn't I do it? Especially if the robot's working, he can make money. But the thing is I feel like this robot could make money over a month period, but like in the long run, it has some issues. And I don't want to pay the professional fee if my focus is going to be micro treasury futures. You know what I mean? Now move buys to the dark pools to supercharge the downtrend. Yeah, so it's true. Like, so one of the things that you got to remember about the dark pool is that you still need to have a buyer and a seller, right? Target filled sounds beautiful. That's a default NinjaTrader sound. I should make my own sounds for it, but I don't actually, because they're on sim accounts and everything else like that today, I don't particularly care, but before I was muting them, so. What if we could see that it's also people pulling their bid and hitting at the market? Well, I mean, you kind of can, right? It's really hard to sort out, right? So you can definitely see as it is happening that they're pulling the bids, because when I come in here and I look at the trade and I see, oh, it's every tick up, it's only 500 contracts when normally it's like 3,000. The problem is just you don't know that it's going to do that until you see it print. But that's why watching for that sort of behavior on the DOM is important, right? So if I come in here like today, so today we had a monster move in treasuries yesterday. Is the high demand for treasuries still there? I don't think it's going to be, but it's a possibility. I need to be looking out for it. So if I'm coming in here and I see them go up and they take 20 with only 400 contracts, then that immediately makes me think, oh, they're doing it. Especially if it was like they went down to the low and then they came up and then hardly any contracts traded there. That to me is like, they're doing it right now. Why doesn't the market push the market up as much as the lack of latent liquidity? Well, because what's happening is you're selling 10,000, you're buying or selling 10,000 contracts. When you move it, the initial meta order going one way is going to take out, 2,000, 3,000 contracts per price on average. And then on the other direction, they're going to be taking out, 1,500, something like that on average. And so it's going to end up moving further, right? But I think you're touching on something else, which is that for the kind of short-term moves that we often try and trade in the treasuries, where we're maybe even looking for 2 to 4 ticks, a market maker could entirely make that move happen just by pulling his liquidity. Yeah. And it's really frustrating. I'm being so ADHD today. I'm just like uncomfortable everywhere. So if I'm making weird noises or doing weird stuff, I apologize. So I was gonna say, like, over in Discord, somebody was saying, well, I don't particularly care why it happened. I'm just, I saw that it had some momentum and I went with it, right? And this is where when you understand how some of these moves work and what the possibilities are, I think you kind of have to go and say, if I make all of my decisions based off of the technicals, even if they're really good technicals, I'm going to have problems, right? Because these moves where they pull the liquidity or it's a meta order are going to be much larger than what I make purely from market making. And that's going to eat all of my profits away. So you have to understand enough about the fundamentals to protect yourself when those moves happen. And you have to understand enough about it to know when to trade and when not to trade. To know when, hey, the market maker could just pull price on me 4 ticks and screw me out of my position, even though I have a good one, right? Can you use the time and sales to see close side orders? Because I know standard it shows the opening. Well, so I don't think it works like that, Noah. So when you get orders that come in, all you can see is a market order and the price that it occurred at. It's actually like really frustrating because the exchange should send more information than that. There's way more information that they could share. In particular, the exact time that the trade occurred on the exchange. They don't tag it with that. So that you could go back and say, okay, what was the current bid ask at that time, and therefore was it a buy or a sell? It doesn't even tell you if it was a buy or a sell. We're reconstructing that using the information that we had, and our reconstruction is not perfect. Right? Whether it was opening a position or closing a position, that would be amazing. But no, you cannot see that. If you're worried about dead air, it's easy to hook up background free music to your stream. Well, I've thought about that, and I actually messed around with it a little bit because I've got like great mixing stuff here. I could do mixes for you. At the time, there wasn't a whole lot of royalty-free music that you could use. Now there is. But when I tried doing it, the general feel that I got from people was that if the listeners want to hear music in the background, they just open up their own. So I'm not so worried about dead air, but I do try to keep some things talking. But I'm more just like uncomfortable and swallowing and all these sorts of things, and you don't want to hear that. So like the thing is my mouth feels dry and my lips feel really chapped, even though I've drank a lot of water here. So anyways, here in the treasuries, I think is a good example because I know that there's a possibility that it could just turn risk off and just shoot up there. But at the moment, my read from it is like, if I were to take a position, I could very easily get screwed. You guys had said something else that I we needed to talk about, but I don't remember what it was. Let's see here. I must have subscribed after seeing one of your instructional videos, but this is the first time I've seen you live. YouTube put it in suggestions this morning as it was early for my usual stream earnings. Yeah, that's kind of weird. Well, I think you must not have been, because there was, at least 2 or 3 other guys here that sounded like they were first time visiting the stream in the morning. But we do this every day. In fact, the whole channel started with the stream. Like, that's the funny thing, is we did the stream. YouTube doesn't really promote the streams, though, very well. I have to say, it's better. Like, I got a lot of good viewers from the stream. It's just, it pales in comparison to what you get from search, right? Laser Eye, good morning. I do kind of wonder why it might be showing it today. But I don't know, maybe something that can happen is like you'll get a video reported or whatever, and even if it's a fake report, the robots just you look at it and do their thing, and they might throttle the video a little bit because of that. If you miss a day or 2 of streaming, you fall off the edge algo-wise? I don't know. So, like, the thing is I stream every weekday, and I have for 4 years now, I'd say. Now that it's 2021 and we're past, because I started in like April of 2017. So I've been doing it for 4 years. Whenever your live YouTube shows me on every recommend. Well, so do you have the bell icon checked? So that's one of the things, is if you click the bell icon, and then depending on how you have your own personal notifications set up, then that really makes sure that you'll catch every live stream and every new video. So my understanding is that the number of bell icon subscribers that you have is normally like 1 to 5%. And on this channel, it's like 10%. Like a lot of you guys use the bell icon. I think it makes sense. For the way that we use this channel, it would make a lot more sense to have this, if there was one channel that you had using the bell icon, it would be this one. But the other thing is that there have been occasions where something got flagged or whatever, and so like the video won't even show up in search. So that's why I also have in the video description a link, like the permanent link to the live stream. So if you just bookmark that, then the really dedicated followers, they come in, they just open up that bookmark. You used to show everywhere, but now I use the bell. Now, so how long ago did that change, though? So the thing that I find so weird about it is that it feels like I will notice changes in numbers and stuff like that, but it doesn't seem to be correlated to anything that I do. Doesn't seem to be correlated at all. Like I did this whole thing where I cleaned up the channel page so that the past live streams won't come up as recommended for you, except for maybe the current days, depending on if I choose to set it to unlisted, at what time I decide to set it to unlisted. But I've been leaving the last day up. Last week I took them off immediately after the stream to see, okay, so does the views go down because people aren't seeing the stream on replay and watching it on replay, because I know that people watch them on replay. But then I go and I look at the hours watched and the views and all of these things doesn't change in an appreciable way. Your channel should have a lot more viewers by now. You have knowledge. You just have to spice it up a bit, make it sexier without compromising your goals or principles. Well, I do think so. Like, one of the things is when you look at, so let's come back and look at it. One of the things is that I am just not posting enough videos. I really should be posting more videos. If I was posting a instructional video every week, that would help a lot. But with a baby, it's been too hard to do that. It's getting hot in here. So let's see here. Oh, that's right. So the last few videos that I've made over the last 3 months have been trading strategy development video series. So a set of 4 videos, and then my video on the treasury market yields plummeting. And those are just not really, those just didn't take off. And part of that is like, what do you put in the title that people are searching for to really make that one work? You know, it's hard. It's a hard call. Your live segments could be less boring numbers. Well, especially at the very beginning of the stream, when I do the analysis, I don't really talk about the numbers, right? I just go, is it up or down? And what are some of the fundamentals driving that? And then, like, what news we're expecting that day and the possibilities that we need to look out for, right? And then when we're talking, we talk about whatever we want, whatever you guys want, right? But so RJ Will says Day Trader Paradise and Matt don't post instructionals. It's a good point. But Day Trader Paradise spent a lot, and I mean a lot of money on advertising. So I think that's how he built his audience. And even then, I didn't think that his audience got all that big. And Matt posts his profits in the video thumbnails. So I think that that's why they get the numbers they do. It just shows, because I am very much a, highbrow, try to use the math, try to understand what's going on as much as possible. Doesn't necessarily make you more popular on YouTube. Doesn't necessarily make you a better trader either. Although I do think that it's going to be really, really hard for you to maintain consistent profitability without those things. So, But again, like I said, for the live stream, it's fine. Doesn't matter. For the larger channel, because I would really like to get to 10,000 subscribers, or actually, like, the thing is that if I did nothing, if I changed nothing, probably we would get to 10,000 subscribers in a few years. I've been surprised at how fast it's been growing. Like, you do nothing and it still keeps going up. We're at like, what are we at right now? Almost 6,200. But, you know, if I get some other videos like the trading computer hardware video that kind of reaches a wider audience, that could make a big difference, right? And then if, you know, hopefully once I get to that point, when I make videos that are more like market analysis videos, like I did with the with the treasury yields plummeting and everything, then those videos should do well too. Because the thing is you've got to get the algorithm to start recommending it to people on their homepage when they haven't subscribed to you, right? So what you got to do is you got to have a wide enough subscriber base that is getting the recommendations for your videos, and then one of those videos takes off among that base audience, and then that's when the channel like really, really blows up, right? So you know, that means probably I'd need to be posting videos every week and that sort of thing. And it's just, it's a little bit too hard to do it right now with the baby, unfortunately. Clearly you've considered and done a lot, yeah. Well, I tell you what, man, when you're doing futures trading and when you're doing YouTube, you know, I probably spend 20 hours a week on the futures, 20 to 30 hours a week on the market stuff, and another 5 to 10 on the YouTube channel. You know, and you do that for 4 years, you get a lot of stuff. I wish I could say that, you know, then you're the expert and you just smash it and win every time. You know, it's still hard. And I wish I could say, the YouTube channel makes so much money, I just don't have to work anymore. But that's kind of the exciting thing, is that we're on like the precipice. It's like, you know, something could just randomly happen. YouTube could just magically decide to blow our channel up tomorrow for no reason. As far as I understand it, it could just for no reason decide to blow us up tomorrow, you know? And all of a sudden we have like tens of thousands of subscribers, and we would be making so much that I could do YouTube full time. You know, could happen. I could probably go and start doing YouTube full time, and that would be a huge risk that I couldn't do, but I could probably would be able to get the channel to blow up that way if I was posting videos like every day, right? Another thing is TikTok. We do pretty well on TikTok. Or at least I'm always surprised. So like by default, well, when you started, it was only like you'd get like 50, 100 views. But now almost every video that I post gets 200. But then some of them will get a couple thousand views. And, you know, and I've had some that have had hundreds of thousands of views. So you build that up and you get enough subscribers over there, and then once you're in the tens of thousands of subscribers on TikTok, you know, those start coming over to YouTube, and that can help too. It's hard to come up with ideas every day for content, though, I must say. There's the link. Thank you, Win. Another thing, Alan, though, is you got to realize a lot of what I know, I would not have looked up or realized was a thing without you guys on the stream. So it really is a collaborative effort. Like, I've learned a lot about advanced order flow concepts from a book that was recommended here on stream. And that got me very much into reading more scholarly studies. And in Discord, in the education channel, you know, we're often sharing studies like that you can, you know, pull some information from. And that's where I think what we've been doing on this channel kind of becomes special or unique is because most people are just posting, here's the typical technical analysis pattern that I read from a book, whereas we're drawing a lot of our knowledge from academic resources or from the Wall Street analysts. I do a lot of reading about that stuff, at least what I can pick up from Zero Hedge and others and stuff, right? And that makes a big difference too. So it's kind of a collaborative effort here on this stream for sure. Well, man, when my robot came in and, took a second trade, I was like, why is it taking a second trade? That's a little weird. That's making me a little bit nervous. And it's doing really well so far. You know what will be funny is if after, I've given up on the combine, now the robot just kills it in sim and, goes straight to making the target. Because if it catches 2 in one day, that's pretty good. So they're starting to threaten a little bit lower in the treasury. Oh, I have my financial juice turned on. That would help. Now I see Forex Live tweeting, crude oil continues its decline and moves below the 70 level. You never said, Stick, why you wanted to get short oil. So it's such a strong move. Yada, 3 minutes open. Speaking of opening Yada, open a free FDIC insured savings account with Yada. Every deposit helps you save money while entering you in our weekly sweepstakes with prizes up to 10 million. You know what? I don't talk about the Yada thing enough. When TikTok said no more financial services advertising, and I was like, well, Yada probably fits under that category. But I have to say, if there was anything that should be easy to market, it's Yada, right? Because it's just a savings account, right? So there's no cost to you. In fact, you make money from opening it up, small amount, but you'll make at least $10 opening up an account. and then you can turn around and you get an affiliate link and you can give it to your friends and family too, right? So and it's fun. I think it's fun because you go in and see and then compare with them like I do with my parents, and then we look at what we got that week. It's great. It's a great thing. So if you haven't checked that out, or especially if you don't have a rainy day fund, because I know a lot of millennials, they don't have a savings account with a month's worth of money, right? Then you should start saving up for it. And a Yada is a great way to do it. Just save $50 every month into the Yada account. It's great. And you'll get a better interest rate than if you did it with a traditional bank. Okay, so we're going to open up here soon in the EE Mini. My stomach is still kind of up, I want to burp and stuff. China authorities are to test all of Wuhan's 11 million residents amid new COVID-19 cases. This story coming out of China today is interesting, by the way, because maybe the U.S. doesn't shut things down again, but if China shuts things down again, and we saw that China had a pretty big impact when they shut down the first time, right? Oh, a little bit more, please. No. There was a decent amount of volume on the open. It was actually somewhat mixed in cumulative delta though. They're still not quite past that last push up in the E-mini was 43.91.50. And you see they came to it almost to the tick. They didn't tick into it. And back to the open. Treasuries are pushing down today, though. Doesn't mean that they're not going to move up today, but I think we got to be careful about that one because they could do either or. They could push up a big today, but it could also be a mean reversion day and they could push down quite a bit. Okay. Oh man, there we go. I finally burped. That was weird. Now, looks like they want to go short. I can't make too many conclusions from the cumulative deltas here, but I'd say that was a pretty ugly excursion there. The overnight low is 43.81. So far, though, I would say this is kind of like the typical action in the E-mini, right? There's usually like a little bit of a buy at the beginning, and then they sell, and it kind of starts to look ugly, and then like they magically pull it out, right? Treasury ticked up one off of that, so maybe a little bit of risk off coming in there.
Order filled.
Guess that was its stop, yeah? Yep. And it's sad. Like, it had a good trade there. They only needed to go just a few more ticks and it would have gotten the winner and it ended up being a loss. Winston posting a good story that's about, I should be reading these out.
Winston's mom says the 2021 holiday shopping season could be marred by out-of-stock goods and shipping delays as the recent floods in Europe and China exacerbate already strained global supply chains. Unterstrich CNBC. Winston's mom says, Western Europe and China's Henan province, a key transport hub and home to several major businesses, are grappling with the aftermath of devastating floods.
Are they still? I guess I kind of forgot about that whole thing. No, I keep seeing this story about Christmas. I think it's really interesting. Like, are we going to have supply constraints on Christmas? And like, I keep seeing over the next 2 quarters, supply constraints hampering the economy. That is a little bit more bearish as well. I'm kind of eyeing it like, oh, maybe we could try buying the dip in here somewhere, but I'm starting to wonder if that's just not going to happen. Like it may just be a sell day, but it's a little hard to sell it at 43.83. By the way, are you there today, Ace? I haven't heard you say anything. Do I need a Pepto-Bismol? I don't know. So we had like spaghetti, and the sauce seemed kind of spicy. I don't know what it was, if it was just that brand is spicy, or but it seemed a little spicy. Tomato can definitely kind of mess up my intestinal balance, so it could just be that, because I had like really bad gas overnight. But then I had like oatmeal. And so like I think that's hitting my stomach, and that's what's causing the gas. So I don't know. It's kind of weird. Like, why would that cause gas? Okay, so just know that the treasuries, they had come back a little bit. They did tick into 31 at one point, but now they're back up to where they were quite easily.
Winston's mom says tomato sauce seems to be a trigger for some people, including me, as we age. I know loads of people who really only tomato sauce every once in a while now because it does something to an older tummy.
Yeah.
Winston's mom says yours is not older, but you are not a baby anymore.
Yeah, because it's just more acidic, right? Oh, look at that. They did not stay at 01 for very long at all, did they? I do. You know what I need? I'm trying to get more sauerkraut into my diet. Because apparently that has good bacteria in it. Like, they did a study where they found that like people that were really strong tended to have more of a certain kind of bacteria in their gut, and that comes from sauerkraut. It's like, okay. It was like a really weird, surprising finding to me, but well, we don't know a lot about that. Like, how does the bacteria get from you ingesting it to your gut? Because apparently when you just take like these what do they call them, probiotics, that not a lot of it necessarily gets into your gut and stays. That's why you're supposed to take like, one a day for a month and all that. Okay, so 2,000 at the high of the day. it's playing out so far exactly like we were suspecting it could. Wasn't saying, when I said I wasn't making a prediction, just like that was a possibility, and now we're seeing that possibility play out, right? E-mini is turning, now they are below the low of the day. They're heading for yesterday's low, which was 43.77.
Winston's mom says good bacteria, it's about pH balance. Most western diets are acid heavy. Yogurt promotes the good bacteria. You can eat 1 cup of Greek yogurt and sprinkle cereal on top or fruit.
RJ Wheel says a study just found that perhaps a bacteria in the stomach causes Parkinson's.
Oh, really? I didn't see that one. So I don't know if I talked about this before, but I found an article. Well, it was like a meta study of sorts, where this guy gave a diet for dealing with psoriasis, and he was claiming that psoriasis was caused by your diet, that like what you're eating causes a leaky gut, and then those things leak out into your body, and you see your body's reaction to it on your skin. It's like, wow. There is definitely a lot to learn in that area.
That are already there and are there to stay. Julia Enders, good. The inside story of our body's most underrated organ.
I'm telling you, one of these days...
Almost nothing influences our good bacteria as much as the food we eat. Prebiotics are the most powerful tool at our disposal if we want to support our good bacteria, that is.
One of these days, they're going to make some breakthrough in being able to study your gut flora and to change your gut flora. And there's going to be like an explosion in medical advancements because of it, for sure. Because like we're just now realizing how important it is. What are we going to learn? I think it's an exciting area of research. Well, the E-mini is trying to bounce here. Treasuries did kind of bounce off a little bit. Like they were putting up a big bid like, no, I still want them. That could be a sign that like somebody was trying to quietly buy up some treasuries, but then when the market went risk off, they kind of had to start panicking.
Ignoring the importance of the gut flora.
Yeah. Well, I don't think they're ignoring it. It's just...
Doctors are already riding that train.
Yeah, it's incredibly difficult.
Had physical anorexia. We spent 6 years as part of a study at USF. Dr. Powers treated my son and we kept food journals and he weighed everything. He talked food for years.
Yeah, I don't think that it's that they're intentionally ignoring it. It's just that in your gut, there's so much bacteria in your gut. How do you adequately study what's actually there? Because you could take it out and go and do a petri dish and it not show up, because that's how they have to do it, right? So it's not that they don't care or anything. It's just that it's an incredibly difficult area to study, and that's why I'm saying, at some point they might make an advancement that gives them much better insights into what the makeup of your gut flora actually is. And probably there will be a lot of big discoveries off of that. Hopefully medications that improve your gut flora to deal with issues like, when it causes depression and so forth. But okay, so there was a little bit of a bounce there, but they came back to the lows awfully quickly. Are they going to go through? It's a tough call on that one.
Caleb says it's already been studied, brother. Certainly more studies needed.
Yeah, but I'm saying there could be like a bacteria in there that's really important, but we don't even actually know that it's there. Or for that matter, for me with the issue that I have where I have ulcerative colitis, there could be a bacteria causing that and we just can't detect it. because you have to, go and take a sample and then do a petri dish to see what grows. And it might not be able to survive in that environment. It might get killed by other stuff.
Good instincts. Microbiota as a key regulator of brain development, aging and Neurodegeneration.
I think I saw that one on Reddit. Well, it depends on when it was posted, but there's been a lot of discussion on Reddit about, how your gut flora could affect your mood. So they keep stepping up to 2.5. Like they're going to get aggressive, but then it ticks back down. So I'm not too sure. The E-mini, it hasn't gone lower yet, but it's awfully close.
Caleb says, oh yeah, more neurons in your gut than in your brain.
Yeah, there you go. It's definitely one of the areas where there's a lot to learn. Okay. All right, now they're stepping up. And the 0.3 pulls. And they tick new lows. Yep, and there's a stop run. And
Mom says good microbiota and gastric disease.
okay, now remember 43.77, it was yesterday's lows.
Caleb says Andrew Wakefield famously got fired for showing this connection.
Oh, really? I never heard of that before. Well, so I'm watching the way they're reacting here. And the Treasury tells me that this is kind of where I normally would want to take it off. Oh, well, I'm not getting like the big absorption there, but well, we'll see. I'm probably going to regret that. I took it off. The thing is I'm not sure. I do think that the E-mini could have another little flush lower and maybe a push beyond yesterday's low. At that point, I'm uncertain.
Winston's mom says CNBC the 10-year Treasury yield was stable on Tuesday, easing some of the concerns about slowing economic growth, after falling back to near 5-month lows on Monday. Winston's mom says, however, oil prices continued to fall, with futures for West Texas Intermediate falling below $70 per barrel.
Ace Trade says
There you are.
short S.
There you are, Ace. It's like, where is he? I went long the Treasury instead of going short ES, but I think that this is like really is a good example of where, like, I bought it at what, 31.5, right? Oh no, I got half. So I mean, I only got 5 ticks off of it, but so it was 5 ticks in the 10-year versus where did we start at? 33.88 to 78 versus 10 points in the E-mini, right?
Trying to work my run around the brain.
And so the on a micro contract that would be like $50, right?
Ace Trade says short 78.25.
On a micro contract, that'd be like $50. In the 10-year, that's like 70 to 90. Maybe this goes to 100, and maybe this becomes an 8 ticker. I don't know. So you get about the same amount. You make about the same amount from the two of them, but in the E-mini, it's like it's all over the place. Is it going to go lower? There's big pullbacks and stuff. And here in the Treasury, it like has never ticked back against you. That's the advantage of it. And you can just take it as it goes because it's super. Well, it's not super thick, but there's a lot of liquidity there. There's a lot of liquidity there, right? Oh, you went short 78? Yeah, I shouldn't have taken that off. Now it's doing this stuff where it's like, oh, I'd still like to be in. I mean, that's only 1-2 ticks, but. $73 now?
Ace Trade says 5. RJ Wheel says nothing but net ace.
Oh. Yeah, I think he should run it. I'm weary about trying to enter into a trade down here. 78 would have been okay. Like that was the thing, is like 78 was a spot, like a decision point. I decided to get out at the decision point. It went down. It's just we could step back up to 78 here, right? So I kind of want to wait for a little bit.
Ace Trade says at RJ Wheel, thanks bro. Nothing like getting in a run, ignoring the open, and still hitting profit targets.
Yeah.
Done by 8. Now what?
So have you been running partly because it's so hot then, huh? I tell you what, man, it rained so hard here in Centerville on, what was it, Sunday night. Okay, so they're maybe working out a little bit of a reversion there. I'm going to come back over here and try and look at some of our options levels. And I'm seeing 61.
Ace Trade says yes. One of my dog wears a thick, black coat when we run. He doesn't like the sun, heat.
Oh. Let's see. So let me read this article. Choppy overnight session saw S&P futures test back towards the key 4400 level, which, as Spot Gamma notes, is a major gamma strike on the board. They note the call wall has consolidated to 4450 strike, which is now the top end of our range on a larger time frame, with a 4375 as intermediate support. So that's exactly what I wanted to know. The chart also shows the inflection point at 4330, below which we still hold as a downside pivot point. That would be a target for our first stage, quote unquote, on a move lower. Nomura's Charlie Miguelia agrees that the 4400 level in SPX continues to just act as an incredible anchor into the weak August historical seasonality and essentially peak dealer / long gamma. However, Miguelia warns dealer desks around the street just keep getting ripped on medium and longer dated downside, as evidenced by 2-minute downside put skew at the 97th percentile. So we keep worried about being short tails, and we'll see any real move to the downside get spazzy really quick. Him noting that the gamma flip level at 4270. So their take is 44 upside resistance, 4375 intermediate support, and 4330 downside target. So here we're right at, I mean, we went past 75, but like we're right there. So if this continues, well, and the treasuries are ticking up there, I'm probably already too late. So I think it's telling me that I could justify a short here, right? The issue here is this could like fizzle out very quickly, right? This could fizzle out and then move us back to 4,400 by the end of the day. I think would be the classic way this plays out. In fact, that could be it right there. I don't know. This is a tough call. It sure did pop back up a little bit. If we were to reverse, I would want to see a more significant, something more significant in the 10-year here. I'm not so sure that what it's showing me at 04.5 is really telling me a whole lot. Just that you could have gotten 3 more ticks. Oops. Nah, I think in that case, taking it off was, based on what I knew, was a reasonable decision. Oh, you know what? We need to do the webinar. I need to go find that link. There we are. To join the event, please follow this link. Okay.
Hello, everyone, and welcome to CME Group's Micro Treasury Yield Futures webinar. Before we
Cool.
get started, I just want to make a quick disclaimer that the current event is being recorded for archive purposes.
This meeting is being recorded.
All right, with that, let's get started. I'm Craig Buick. Like I said, I'm a Senior Director in Client Development and Sales at CME Group. And on behalf of CME Group, I'd like to thank everybody for tuning in this morning to listen to what we have to say about the next iteration of our Micro Futures suite of products. And just a quick note, this one I think is...
There you go. Is the volume on that good?
A different way than some of the recent Micro Futures launches that we've had.
Not too loud?
The equity index, the Micro Futures on equity indexes, the Micro Bitcoin, and the Micro...
I'm tempted to buy the E-mini, but I don't want to. Well, I'll do.
Last month. In that, with those products, CME Group saw a need for a smaller product. We saw a need, in 2019 that, individual traders may not want to trade 150,000.
No, we got to listen to them.
Or even last month that 1,000 barrels of crude oil was a big contract. With this contract, we've sought to not only right-size the contract for individual traders, but we also saw a need to actually simplify this, make it a little bit more of an intuitive and simpler product for individuals to trade. And I think that we've done that, and I think it will usher in kind of a new generation of individual interest rate traders. So it's a particularly exciting.
I hope so.
For us, and again, we want to thank everybody for tuning in today. In addition, I'm joined by Dave Gibbs and Ted Carey, two of my esteemed colleagues. Both are interest rate experts. David in our education department, and Ted Carey in our interest rate business line management. So our product management department.
You took it off?
We're going to do a lot of the
I see. Yeah.
Today, I'm going to act as a moderator in today's presentation. So
Just had to get my notebook here.
I'm going to leave this disclaimer up for you to read. What I'd want to emphasize here is that CME Group has done an excellent job.
I really would have preferred 70 here.
Educational portal in what we call CME Group Institute. And I'd encourage everybody, whether you're a beginner in futures or a seasoned veteran, to check it out, because we have content on that educational portal that I would consider from 101 level all the way to 400 plus level. And I think, like I said, whether you're a beginner, you've been doing this for a long time, I don't think there's any such thing as knowing too much. So please go check that out at cmegroup.com/education. And we've already talked about the recording. And as you can see, this is already an interactive webinar. We're kind of doing this in a panel type of discussion. So we would encourage anyone that has a question.
It's the CME's webinar.
Type it into your WebEx app. And if we see a question,
In fact, we're going to put it over here.
We just sort of botched and has confused everyone, we're going to answer that in real time. Otherwise, we'll save them to the end and answer the questions then.
Pay attention, Ace. This is going to be information that you're going to need to know here. 2 weeks.
Governments globally, and particularly the United States, have spent in the last 12 to 18 months as a result of kind of pandemic-driven shutdowns and sort of...
That is a buy signal I was waiting for, by the way.
More recently, infrastructure here in the States has been well documented.
I think 70 would have been better, but...
When we had the financial crisis, we talked about billions like it was a lot of money, and now I
was thinking about doing that on live, but because of the webinar, I'm not going to.
Talk about that a little bit. How much money are we really spending, and give us an idea of what that means.
Well, thank you, Craig, and welcome to everyone on the meeting. There was a famous quote in the 1960s by an Illinois senator, Everett Dirksen, who said, "A billion here, a billion there. Pretty soon you're talking real money." Now we have to say trillion, which is I don't think the average person can even get their head around the size of that number. But anyway, the debt market.
I'm going to turn it down a little bit there for you.
Grown appreciably. And
why don't you broadcast the Olympics as well? Well, because this is a CME event, so...
This is global debt measured in US dollars, and the red line shows you the percentage of that debt as a percentage of GDP. So while it's been growing over time, this last year we've seen an accelerated rate of debt. And as far as US Treasury...
No, I don't think they will have any issues with them on that.
The size of that debt in proportion to some of the other debt issued. If we move to the next slide,
I mean, I can just mute it like that, but
segment right there at from the bottom half.
I think it's more helpful for you guys to know what I'm talking about.
Has grown in terms of U.S. dollars, but it's grown especially in U.S. Treasury issuance in support of the fiscal spending to combat the economic recession caused by the COVID-19 outbreak. And this is
okay.
It's going to go away.
I understand your concern, Ace. I'm okay with it.
Has been largely absorbed by the Fed purchases, but in actual fact, it's going to continue to have to be issued.
I mean, we've done it before, right? So
spending needs. This is showing the amount of that issuance. Again, the orange segment being just simply U.S. Treasuries, but you'll notice the light.
I'm pretty sure that David Gibbs is more concerned that as many traders get to watch this webinar and learn as possible. So
enormous issuance there as well. All of these have direct relevance, not just to interest rates from the government's perspective, but also from the consumer's perspective.
So Dave, I often
there's O3 again.
Say things like the U.S. Treasury market is the largest debt market in the world, really. Talk a little bit about what does that mean and why?
It's important, Craig, because a lot of fixed income portfolios, whether they're
every time that Ace says like, "Oh, my guy from the CME calls," I'm thinking, "Oh, he must know David Gibbs."
or even mutual funds that are looking for or pegged to performance are pegged to benchmarks on interest rates. And probably the most prominent in the U.S. is known as the Bloomberg Barclays U.S. Aggregate Index, which on the street is known as the AG. And it's an index that's comprised of various forms of debt. And
Want to write that down?
38%, almost 40% of it are holdings of U.S. Treasury securities. These benchmarks are designed on a capitalization basis, which means the more debt that's issued, the more it's included in the benchmark. So the size of the Treasury issuance going up just makes it an even larger portion in these benchmarks. And this extends to global bond benchmarks as well. Of the world index, the US dollar debt's, again, closer to 40%, and it's only going to increase with the increased issuance of US Treasuries. So the fact that the US debt market, particularly in US Treasuries, is growing has implications for professional risk managers as well as for consumers.
So these are essentially kind of the indexes that if
you went to Hogwarts together,
portfolio manager and rates or trader or anything like that. These are two that I would absolutely look at every day. This is kind of what you would look at. These are the indexes.
Yes, correct. And that's how they get their report cards, how they perform relative to benchmark indices.
Okay.
This slide's from the Fed itself, from the Federal Reserve Bank of St. Louis's Fred site. You can go get these yourself anytime you want, but it's showing you the correlation between the 10.
Do you have a recording of this? It will be recording. You'll be able to rewatch it on the CME website.
In the United States. And they're obviously not sitting on top of each other because there's a credit spread between the two, but they're highly correlated. So what happens to the US 10-year yield has direct implications to the lending rates that are offered to US consumers through the mortgage market. This has been borne out by the move to lower interest rates in the last year in response to the COVID outbreak, has led to lower fixed mortgage rates, which has also fueled an increase in the performance of the U.S. housing market and the rise of U.S. housing values. So all of these things, as they relate to U.S. Treasury yields, have an immediate and direct impact both on economic behavior and consumer expectations.
I don't think that one's going to work out.
Underscores how important the sort of 10-year Treasury rate is to people's mortgages, right? Which is obviously an important factor. But I think
in case he can't sleep at night.
But what I think the interesting thing about trading interest rates is particularly the Treasury rates is that really they kind of drive everything, right? I mean,
no. I was writing down this information about the Bloomberg Barclays U.S. Aggregate Index.
in terms of foreign currencies or equities, or even
stopped out,
where it's going to affect the dollar, which is going to affect the commodities. So I think that's one of the things that really kind of makes this an interesting product.
I'm still thinking this is a buy, but I don't know how low they're going to go.
I'm glad you brought that up, because the U.S. Treasury debt's probably the United States' greatest export at this point. 50% of U.S. Treasury debt is held outside the United States as an asset, and as a result of its importance in the global economy, it's the benchmark by which most global interest rates are pegged. Not necessarily pegged officially, but are spread against. So what happens in the U.S. Treasury market extends beyond our shores, and it affects credit spreads. It affects.
I'm stealing that one, David. That was hilarious.
To foreign sovereign bond issuance, and as you said, Craig, that has implications on the foreign exchange world as well as equity valuations. So having a product available that allows the self-directed trader an avenue to express a point of view, or to express a risk position or a reduced risk position in a futures contract, is an exciting additional prospect, both for our self-directed trading community, but also for the exchange itself. It's, as you said in your introductory remarks, this is a new foray for us, and it demonstrates an important consideration, both in the importance of the U.S. Treasury market, but also having a product that's accessible to the self-directed trader.
Yeah, I agree completely. So, all you have to do is turn on one of the financial news networks and you'll see the yield on the 10-year flash across the screen. Let's talk a little bit about what other maturities the U.S. Treasury issues.
Ted, you want to jump in here?
Yeah, absolutely. Hi, everybody. My name is Ted Carey. I work on the interest rate product team. So yeah, I can briefly explain the three of the different types of Treasury securities that are issued. The first is the most short term is what's known as Treasury bills or T-bills. These are really particularly used as a short-term interest rate security that's intended also to help with cash management. So these typically have maturities ranging from 4 weeks to a year. So they roll over, much more quickly than the long-term notes and bonds, which have maturities ranging from as short as 2 years all the way.
Meaning we get to fleece more noobs, says Ace.
Currently, 7 different
well,
in the Treasury market.
I'm sure that they're going to make money off of this product for sure.
And 10-year note. And then there's the...
But it does allow you to make certain trades that a lot more easily
cycle. And
than you could before. So
Treasury notes and bonds have...
you want to make a bet on the yield curve steepening, or, it's a lot easier to do it with these.
Zero coupon.
Right. And so just to sort of clarify that point, Ted, when we say zero coupon, that I'm gonna try to give sort of a real elementary example, and you can.
I click a mouse. How can it be easier?
That's right. But if I'm looking at,
oh no, it's much more complicated.
And it's a zero coupon.
I mean, doing it today is extremely complicated. Doing it on these instruments will be simpler, but still a lot more complicated than trading your E-mini, right?
I basically might give that,
because we're talking about holding multiple positions in different instruments at the same time.
So that sort of kind of 2-ish% interest rate, if you will, is sort of built in to what I pay for that T-bill, because there is no coupon. I don't get a payment, where if I buy a note or a bond, there's some interest rate that's actually on that instrument, where every 6 months, I think it is, I'm actually going to get some payment for holding that. And then I'm going to get all my money, let's say that $100 back at the end of the maturity. That's a pretty good description of the difference there.
Yeah, absolutely. So yeah, T-bills tend to trade, they don't have a periodic interest payment. They typically buy them at a discount to what they call par. So if par is $100, you might pay, let's say, $99 for it, and then a year from now you'll get the full $100 back, the full principal repaid.
Great. Let's spend just a couple minutes, and this could be either Dave or Ted. We've got some slides on how these treasuries actually get into the market in terms of the auction. So we probably don't have to spend a ton of time, but let's just go through that quickly.
Sure, I can jump in here. So The Treasury Department and the New York Fed are responsible for operating the auction cycle for U.S. Treasuries, and that's what's known as the primary market. So several times per month, they will auction off new Treasury securities, and there's a publicly available auction schedule that lists out, which dates and which securities are being auctioned. And about a week before the auction, they're officially announced, and they also tell you the amount of the issue. So they might say, on August 18th of 2021, we are going to auction off a new 10-year note, and we're going to issue 85 billion of 10-year notes. Please submit your bids. And that is primarily participants such as primary dealers and large institutional investors that participate in that auction. And then, in addition, there's also what's known as the secondary market. And so what that means is that after the auction takes place, people can exchange those securities back and forth, competitively with one another. And then, just a couple examples of when the auctions take place, which is important as we get later on to thinking about these yield futures that we're going to talk about. So often there's this, what's known as the...
You got a long signal now?
In months of like February and May and August and November, those are big auctions.
I'm really tempted to take the long with the live account.
Bonds. So for example...
It's probably shit. There might be another little kind of shakeout, but I do think it's a long. Like, I think you could go long and hold it for the rest of the day here.
And at the end of the month, there's auctions for some of the other instruments, such as 2s, 5s, and 7s.
Great. And then
they vary a little bit month to
and
month.
just
Sorry, go ahead, Greg.
The last slide on the auctions, and we don't have to get into the when issue too much, but just the fact that they exist.
That's right.
So, I want to clarify something real quick, Ted, and to kind of go back.
This guy here.
Lending $100 to the government through, let's say, a 10-year note, and obviously $100 denominations are.
This guy here, Ted.
But for sake of example,
he's my guy.
They're going to
look at this guy. He is the treasury nerd.
Let's say.
He is like, I am jealous of this guy right here. Look at him.
Again, for sake of example, and then every 6 months, I'm going to get 75 cents or half of $1.50, just as a loose example. But what happens then in that secondary market, and really and I want to make a distinction between the coupon and the yield, is that, maybe the consensus in the market is that interest rates go up.
Randy sees the long too.
That 1.5% is a little low, so I'm not going to pay.
Why is 71.25?
Exactly that $100.
Okay.
Because I need more. I'm going to demand more interest, and that's kind of how we derive the yield.
Like, I'm kind of thinking 75 was like the options level. This was all stop outs. Should flip up.
It's you're onto it, Craig, but it's the other way around.
I went the wrong way.
They at that moment didn't have enough momentum to continue pushing down.
And interest rates rise to 2.5%.
Caleb doesn't think we've hit the low yet.
Coupon now.
Yeah, the issue is that I'm seeing is I'm not sure if we've posted the low of the day today, but I do believe that we're going to close the day above 43.70.
The opposite occurs when interest rates fall. If you're at 1.5%.
That's my prediction. The S&P 500 will close above 43.70.
Coupon is now more valuable, and it will trade as a price at a higher price than par. That accounts for our audience for the reason that coupon securities trade in price terms. Now, this is the backdrop, and this is what's going to be important in our conversation today. Is that
they only got
with
the one contract
product that we're introducing, you don't have to be aware or even pay attention to the coupon level anymore, because we're not trading these in price terms. And I think Ted can go into the wonderful nuances of that in the next couple of slides.
Yeah, I think that's a good segue. And I wanted to make that distinction because, as Ted's going to talk about, we're going to quote these in yield, and I want to make sure that...
You're annoyed that you went sim. Well, why did you go sim? I'm interested.
So I think that's a good segue, Ted. If
just because you already made your money for the day and didn't want to screw it up?
Talk about.
Yeah, so I'll jump in here. So, first thing I should point out is that, CME has a tremendously successful Treasury futures product set, which is widely used today by a variety of participants, from banks and asset managers to active.
Yeah, they're buying it like crazy.
Risk and Treasury markets. And the daily volume in those futures products is actually about the same size as the entire underlying cash bond market. So there's a ton of liquidity and active trading in the existing products. That said, we do recognize that there's many people that are not active in those today. And so what we've decided to do is reimagine these products into a new design that meets the perceived needs of an individual active trader. And so that's why we're here today to present micro treasury yield futures. And the first and most important thing to remember about this is that it is not a miniature version of the existing products, nor is it a mini version of actual treasury security. It's a completely new design that we're here to talk about, and I will, on the next slide, go through some of the specifications. So, the first thing to know about this is that it is quoted in yields. So it's a yield quoted product, which means that at expiration, it will settle to the yield of the on-the-run treasury security. So, connecting that back to the auction cycle that we just talked about and the earlier discussions about, the 10-year yield number that you see on television and in the newspaper every day, basically what this means is these products will directly reference the most widely followed metric about U.S. Treasury markets. So anybody that's, discussing the state of the economy or the macro environment, this is the number that they typically are paying attention to. And so
LCL moved a yeah, let's check over here on our other screen.
Second thing to note in terms of, the interest for the active trader is that it has a really simple cash settled design.
Yeah, oil's bouncing.
There's no delivery mechanism.
See, gold moved up a little bit today, but it's still really constrained.
Exactly the same, which is $10 per basis point.
The dollar flipped and flipping around now too.
Moves from 1.5.
And you can see what happened here in the treasuries.
6%. That's
it was another bull flattener move, but the spread isn't changing a ton.
Per basis point or $100 on that move if you were long. We can go on to the next slide and talk a little bit more about the yield terms. So, as we were mentioning before during the discussion about the coupons.
Very rangy.
Although all the transactions in the secondary market are generally done in price terms, many people pay attention to the yields because it's a way of standardizing various instruments.
The interesting question to me will be if they close above 4,400 today.
That into context. And it also essentially signifies...
Assuming that we really did get the bounce there, it looks like that is the case.
So, in this example, as shown up on the screen, if you were to buy the on the run, which essentially means the most recently auctioned 10-year note, and it has a 1.62% coupon, but if you hold it all the way to maturity, the yield to maturity is expected to be 1.41% right now based on the price and that coupon.
Yeah,
and
just to put up...
The price is actually a little bit above par, as you can see. So the price of par is 100. You're paying a little bit more than 100 for it, but you're going to get 1.625% every year. So the yield to maturity is 1.41.
Treasury's coming all the way back.
Craig.
Yeah, I just wanted to put a finer point on something you just said, which was, one of the nice things and what makes these products simpler than, the products that we have today in terms of understanding is that the prices, if you just have the price of the 2-year, the 5-year, the 10-year, and the 30-year, it's tough to figure out what exactly that means in yield. Whereas these, if you look at the price on the 2-year, the 5-year, the 10-year, and the 30-year that we're going to launch in the middle of August, that is what the yield is. So you can make a very quick comparison, not only on just the 10-year, but also on the 10-year yield compared to the 2-year yield and the 30-year yield. So it makes it very simple to really kind of take a look at the entire U.S. Treasury yield curve. And with that, we'll
Vlad says it has to be some algo programs. I think it's just the options traders getting all messed up, right?
A bit about terminology because this is important, and fortunately, the math is simple here. It's a bit like the metric system. Everything is base 10. So, when people say a basis point, what that means is 0.01% of yield. So a full 1 percentage point represents 100 basis points, and 1/10 of a basis point, which is actually the minimum price increment change of this product, is essentially 0.001%. And the way that we've defined these contracts is that as the yields of treasuries moves up or down, you will make or lose $10 for each 1 basis point movement. So back to the example I gave before, if yields move up from 1.50 to 1.60, and you are long, you have made 10 basis.
We'll never know what's causing this to rise. I personally think it's just the universe trying to mess with my head. We might get some really good explanations, but in this case, probably not.
You would have made just $1 in that.
The thing is that I think that some selling on the open was a little justified, right? I don't know if they justified moving as low as they did, but I think that what's happening now is like order flows are taking over.
1.50 bid at 1.
The reason for the initial move doesn't matter anymore, basically.
A $1 difference in the bid and offer, which is obviously a very tight market. Market quality. So this is just a little bit about, so if you want to just kind of explain this slide real quickly, Ted.
Yeah, so these.
I'm going to take mine off. They're right there.
What the benchmark value looked like on a couple particular days. So essentially at the end of June, from the second to last day, June 29th to the last day, the 10-year benchmark, I'll keep using that one as an example. The yields moved down about 3.4 basis points, right? It moved down from 1.478 to 1.444. So it essentially, if you were long that product on that day, you would have lost 3.4 basis points, which is in their case $34. And one nice thing that I think you'll realize very quickly about these products is it makes it very easy to spread them amongst each other. So, for example, if you wanted to put on a trade to manage risk as the difference in yield between, let's say, the 10-year and the 30-year, or the 2-year and the 10-year, it's a simple 1-to-1 ratio between all the products, and you can calculate the yield spread difference very easily by just subtracting one from the other.
And this is very similar. So I think one of the
Go ahead, Greg.
I'm not sure there's a lot of reason to spend a lot of time on this, but I think one thing that's important is to point out that when we say that this product is cash settled, it means that if you hold this until it expires, until this futures contract expires, you're at no risk of an obligation to either take or make delivery, which isn't true of all of the products at CME. So when a cash settled product expires, it really simply goes away with a cash transaction. So if you've made money throughout the duration that you've held it, then your account's going to have more money in it than when you started. And if the position's gone against you, your account's going to have less money. But you're under no obligation to make delivery of a certain amount of treasury debt or take delivery, which obviously a lot of individual traders wouldn't want. So it's an important feature of these new products is that they just settle the cash in a simple cash transaction and your position goes away. But you know what, I would want you to just spend 30 seconds, Ted, on what if I'm long the yield contract and I think that yields are going to keep going up as I come to expiration of my futures contract. I don't want to have no position. I don't want it to cash settle. I want to maintain that long position. What do I do?
Yeah, absolutely. And so that's brings us to like one of the very key common features of futures markets, which is what we call the roll. And so essentially, what you would do is if you were long, you'd sell out of your, let's say, June expiration, and then you'd buy into the July expiration, and you can trade that roll package as a single spread. So there's an instrument listed that will allow you to sell June, buy July, close out of your June position and reestablish it in July. And that way, you've essentially extended your exposure out another month.
Right, and that roll, that spread market is important because it does allow you to efficiently.
Well, why would I use that instead of just doing it manually?
Trying to leg into two different legs and things like that. And in most of CME Group's major products, they have a lot of liquidity providers or market makers that provide that spread market, again, making it very efficient to do that. So I think that's an important part of futures trading that we wanted to get across. So with that, Dave, you want to take us through kind of a hypothetical trade to kind of show everybody how these things might work in practice?
Yes, thank you. Let's look at, and again, these are for illustrative purposes only. We're not advocating any kind of trading strategies here, nor making any trade recommendations. This is simply done to give the viewer an example of changes in prices and what that means from a theoretical P&L standpoint. But let's start with a directional or a price movement.
Okay.
As a trader, you expect, for whatever reasons, the economic indicators are going to show higher inflation, which you believe will move the yield on the 10-year note to a higher level. So in front of an economic indicator release, you buy the micro treasury 10-year note at an equivalent yield of 1.350%, and anticipating that to go higher. So you're buying the futures contract with the expectation that the yield will go up. You get an economic release. It's as you expect. The yield on that particular product.
This case study, like a change of 10 basis points, that's a big change.
At which point our trader exits and offsets her.
But you would have to hold that one for a few days, yeah.
Buying the 10-year micro yield contract at 135 and selling it at 145.2, you've taken out 102 basis points, or 102 tenths, 10.2 basis points, or 102 tenths of a basis point, or 102 ticks, as we might say in the futures market. Each one of those minimum tick increments is what
You mean he does seem to be having some trouble with this level.
would have resulted in a $102 profit. If, for example, this trade didn't work out as expected and the number was lower at the release than she expected and yields fell,
you think we hit the local high point 2 A's? Well, you could definitely see the flow there when it happened. Like look at the volume profile that it left behind.
Loss or $53.
Like there was definitely some selling demand or whatever you want to call it in this area. It doesn't mean that it's not going to push through it later. It was just like very short term. It made sense to manage the trade and take it off there.
Right, and Ted touched on this just a minute ago, David, but I think it's worth emphasizing how simple the construction
kind of makes me wonder now if they like rest here
or trading.
Does that open the possibility for them to sell again?
30 or any combination, that a trader might want to take on the shape of the yield curve. So, in other words, not just making a trade with the assumption or the hopes, if you will, that the 10-year yield is going to go up, but making a trade that maybe the 10-year yield is going to go up relative to what the 2-year yield does. And because these are all
on the phone with the power company explaining how I need to pay the bill with this sim money.
Trades on a one-to-one basis, you don't have to worry about doing more 2 years than maybe 10 years or things like that.
I should have taken it. That would have been commissions for a few months, right?
Interest rates, a lot of them will trade not really kind of one point on the yield curve going up or down, but how the yield curve's going to be shaped in the future. So I think it's worth going into the next example that kind of talks about that.
Exactly. This is an enormous part of the professional interest rate market trade.
So this is what makes me interested.
Be concerned. You're always concerned about the directional component of a yield trade, but at the same time, there's the slope of the yield curve itself that's also a trade. And Craig, as you rightly pointed out, that slope changes. It's very dynamic with respect to what's going on economically, what's going on with the Treasury issuance, what's going on with expectations of forward market conditions.
Can't get upset over money you didn't make, yeah.
Not necessarily the direction of the market that the trader's trying to capture in a yield spread trade, but the...
I mean, I think we made a pretty good call there on what it was going to do today, so I think we should give ourselves a pat on the back anyways. I've been really struggling with that sort of a thing lately, so to have caught it that well is really good.
They all have the same basis point value or dollar value of an
and I'm going to jump in too, right, Dave, before you get into the example, because I didn't see it in the slide, but just when you say steepening, that really kind of refers to the long end, so kind of out towards the 30 years becoming higher relative to the short end of the curve. And when we say flattening, it really means that
the thing that I find so weird is that like I didn't do anything different. Like
picture a graph.
making that call and everything was just kind of like almost unconscious to me. I'm almost having a hard time going back through what was it that I saw that I thought made a difference. But then like last week I was doing that same thing and it seemed like I was just wrong every freaking time, you know?
Shorter. In rates trading, this is a very, not just a common trade, but it's also a common risk. And for
okay, yeah, that's where your stop was.
Curve is very much a part of their daily conversation. So what these products allow the self-directed trader access to is,
you know, you should
point of view about the slope as well as the level.
You should try the ATR stop.
And they can be applied very simply.
So do you see this little pink and yellow line on the screen?
It's a wonderfully simple concept. So let's walk through an example of that.
This is an indicator. If you hop on Discord, I can send it to you. If you send me a message on Discord, I'll send it to you.
Between, say, 2s and 10s, with common yield curve expression.
But it's basically a stop based on the average true range, a multiple of the average true range.
Or the yield on the 2-year note is going to go down.
And you'll notice that they like seem to actively go for it. It's like because they know there's going to be lots of stops there.
Doesn't care which one makes it positive. I might think the yield of the 10 goes up, but if the 2 goes down, look, I'm just as happy. The opposite could occur. If I'm long the curve and the 2-year note yield goes up, but the 10-year remains relatively static, the curve by definition is getting flatter, not steeper. So what we want to demonstrate here is that by trading on a one-to-one basis, selling the 2-year yield and buying the 10-year yield, you've got an initial difference of where did we started off at the 1.121 yield difference, and then offset the trade at a 1.297 difference, or a change of 17.6 basis points. In this example, the trader was rewarded favorably because the slope of the yield curve in fact steepened. The yield on the 10-year went higher relative to the yield on the 2-year note, resulting in a positive gain on the spread on a one-to-one basis. Now, it's important to note that in spread trades, it's not uncommon for one leg of the trade to perform well and the other to not perform or perform negatively. That's not only common, that's general.
See, this is interesting because these spread trades are something that I think we could justify holding for long periods of time.
Necessarily have to get the yield change. It's the difference.
And the way that it moves tends to be a little more consistent.
Long the yield on the 10-year and having it go up in proportionally long.
That is to say that I can predict whether we're going to flatten or steepen over a 6-month period a lot more accurately.
Because we talked about the slope of the yield curve, but oftentimes,
obviously it's never going to be perfect, but I bet you I'd get a higher win rate on that compared to like long short the S&P 500.
Graph again, but the long end shifts up more, and so to your point, I think it's very common.
Or long short the treasuries themselves for sure.
You're going to be naturally short one of them. The whole yield curve does move, but you're hoping that the one that you're long moves up more. In other words.
Yeah, it's a way of not necessarily expressing a view about the level of yields, but the slope of difference between those yield points. And that's what's nice about having the two.
Apparently, somebody left Blizzard over the lawsuit, but it's not Bobby.
Of the U.S. fixed rate yield curve available to express either a point of view or
it's just the offering. They shouldn't give up on that.
A risk position in slope using these contracts.
So I think we've done a pretty good job of covering that spread trade. I'm going to actually skip the second one because I think that we've been pretty emphatic on that already. So, but I think it's worth pointing out the tools that the CME Group has made available, not just for interest rates, but obviously we're going to get specific on interest rates. But this quick strike suite of tools really is applicable across asset classes and absolutely worth pointing out. So David or Ted, maybe Ted, if you want to talk about the Treasury Analytics page just for a second.
Yeah, absolutely. So on our website, you'll find some web tools that have lots of information about the U.S. Treasury benchmark, which is what is used to produce the final settlement price of the product. So for example, on this page, you'll see those 7 on the run tenors that I mentioned. It'll show the maturity of the bond that is being used in the calculation that day. So, for example, on the day that this screenshot was taken, the maturity date of the 30-year benchmark was the May 15 of 2051, looking down there in the bottom column. But later this month, once a new 30 years auctioned, that maturity will flip to 8/15/2051. And then it also shows the price, the yield, and the volume, the notional volume that was used to calculate it.
I'm going to type something here.
The recent yields on a few of the last couple of days, and you can see a history of all this on the website.
And this is, it's worth pointing out, this is simply an excerpt from the Treasury Analytics website that's available at CME Group's at the URL that you can see below. But there's actually a ton more information that if you actually go to that website that you can get, and it's all for free too. And you can see the quick strike word in that URL. Quick strike represents an entire suite of products that CME Group's made available that I would posit probably 20 years ago would be in the thousands of dollars worth of financial software that we make available, like I said, for free. And a lot of it is options analytics and options volatility, but just a lot of information. It's well worth checking out because we've put a lot of resource time and energy into developing it, and I think it's valuable software. And so I think with that, this is the CME Institute. I mentioned this at the onset. It really is a truly world-class educational portal for futures and options on futures. And like I said before, it has content that, again, I would suggest is 101 level all the way to sort of graduate level content. So it's absolutely worth checking out, regardless of whether you've been doing this for a long time or you're brand new to it. So I know we've got a couple of questions, and I'm going to kind of put David on the spot with one of the first ones that we saw. And I want to point out that as CME employees, we need to be very careful about about trying to sort of give any advice or anything like that on what might happen. But we got a question on the 10-year. Can the 10-year serve as a signal to trade the 30 years? So Dave, maybe you want to just kind of talk about the macroeconomics that might affect the relationship between the 10-year and the 30-year yields.
Well, they did rise back up,
Again,
but
Craig, thanks for reinforcing.
still a little bit of selling up there.
We're here to provide information and education, not to provide investment or trading advice. But when you look at the Treasury curve, not all points along that curve are going to respond similarly to the same piece of information. The short end of the curve, let's just refer to that as like the 2-year notes, maybe extending to the 5-year area, are much more highly sensitive to a monetary policy by our central bank, the Fed. So if the Fed, for example, currently is in a zero interest rate policy, the impact even on economic news is going to be muted on the 2s, maybe out to the 5-year end, because the Treasury's made it very clear they're not changing their short-term interest rates immediately. The impact on the longer end of the curve is more impacted by expectations of either inflation or future rates in general, so that their sensitivity is a little bit greater to current economic and forward-looking economic news. So whether the 10-year is an indicator for the 30-year move could be, I don't know if that's necessarily a correct statement or not. I think what the 10-year and the 30-year tend to react similarly to economic news, particularly inflationary news or non-inflationary news, where the 2s to the 5s tend to respond more to Fed policy type information. So if you're looking to trade the longer end of the curve, you're probably going to be much more attuned to what's going on in general economic terms. If you're going to be looking at the yields between the extreme short and the extreme long end, you're going to want to be sensitive to the whole picture.
Thanks, David. There's a question here, and I think it's one that we were a little remiss not to sort of point out explicitly, but I want to address it just real quickly. Somebody asked, basically, if yields and prices are inversely related to each other, and the answer is yes. And And I think we sort of gave some examples, but we didn't state it explicitly, but that's absolutely true. So if you were trading, let's say, the current CME products that are quoted in price terms, you almost kind of have to reverse your thinking a little bit, because as the price of a note or a bond goes up, it indicates lower yields. So now that we're quoting these in yields, you have to kind of flip your thinking a little bit. I think in some ways it's a little simpler to think of it in yield. If it yield's going up, and that's typically what's quoted in the financial press and stuff. But that is true. So when prices go up in these instruments, it is indicating a lower yield. So I thought that was worth pointing out explicitly. Ted, are there going to be implied spreads on intercommodity spreads like knobs and 5s over 10s and things
Yes,
like that?
there are. Yes.
There will be implied.
I know some people are already familiar with, like, let's say the knob spread or the fob spread in the existing products. So we will similarly list an implied spread between the 10s and the 30s, and between the 2s and the 10s, between every combination. And we expect that will be actively traded, as you do not have to leg the instruments. If you want to say put on a 2s versus 10s, you can trade that as a single spread package.
I sure hope that my data platform gives those to me, so I could just directly trade into that.
In these spreads and make sure that we have liquid markets, actually both in the spreads and the outright. So it's good to hear that.
Will that decrease my commissions?
Spot a little bit again. We got a question here about the bond market being known as the smart money. And does fixed income market lead the equity market in any way? And obviously, as we don't refer to things as smart money and not smart money or anything like that. And we alluded to some of this earlier in terms of interest rates sort of driving everything. But maybe if you want to kind of go back and expand just a little bit on that.
Well, I don't know if they lead, but they certainly influence the pricing mechanisms. And what's important there is that
that is a good way of answering it.
Markets, at least in terms of U.S. dollar markets, are interrelated. It's a dynamic, organic relationship. In other words, nothing happens in a vacuum when it comes to capital markets, whether it's the equity market or the interest rate markets, and by extension the foreign exchange markets as well. So it's not like you pull one lever and something happens. It's all of these things, while they may not work in tandem, they're working in relationship to each other, but yet still independently. So if rates suddenly move sharply lower, what's moving the rates lower could have a very definite impact in the minds of an equity markets trader. Also, if say the equity markets are moving up or moving down sharply, that might also impact how somebody refers to the treasury trading. And depending on what's happening in short-term rates, has a direct impact on the valuation of foreign currency expressions. So I don't think that one, and whether there's a leading or a lagging, I'll leave that to the market to decide and the individual trader to
I had a little slip there.
But I would say that they're all definitely influencing and responding to and reacting to each other.
Right,
it's very, very dynamic.
I think that's a good point. And you mentioned that the dollar could be impacted, and dollar relative to other foreign currencies, which then could impact things like even the price of crude oil. So I
just realized everyone is bald. Are they all bald?
And I think that's well.
I think so.
Margin offsets on curve trades.
Yeah, that's important to note too. That there are typically margin credits on spread trades. So, for example, if you're long 10s, short 30s, there will be an offset such that you're not paying the full margin on both amounts. I don't think we have the exact values of what they are, but for example, in the existing Treasury products, that's upwards of 50% offset.
I think we got a question on will there be an ultra bond. I think it's worth pointing out one of the differences between this product and the current Treasury futures products that we have is that these products, so the 2, the 10, the 5s, and the 2s, 5s, 10s, and 30s, are truly the on the run, as we talked about, which means they're based on the maturity that's closest to the one that was just issued, or in other words, the one that's closest to 10 years or 30 years or 5 years out. Whereas the products, if you actually dig into the product specs on the futures that we currently have available, you'll find that the 10-year, the classic 10-year, if you will, is actually
really more like a 7.
of a 10-year note that might have, I don't know, Ted, correct me if I'm wrong, 6 to 7 years left is what you're going to find there. And then the ultra 10-year is what we launched a little while ago to sort of get something closer to the 10-year. So there is really no need for us to do an ultra of these because they truly are based on the treasury issuance that's closest to the year that, that is stated in the product. So I don't know if there's anything more Dave or Ted want to say about that, but I wanted to point that out because we got a question on it.
No, that's exactly right. I think the closest analogy for these products is the underlying cash treasury security, which is, the number that people see on their screens every day. So it is not necessarily exactly the same as the existing products.
And Ted, there's a question here, and we talked about it early on. What if the treasury auctions, or what happens when is a better way to state it, the treasury auctions and new issuance in the middle of a contract?
Yeah, that's a good point. So the contracts expire on the last day of the month, and they expire based on whatever is on the run at that point in time, which is really important to think about, especially if you're trading a contract before it expires. So, or before the auction, rather. So, for example, on about August 15th of this month, there will be a new 10-year note auction. So if you were trading the August future hypothetically today, that is going to expire based on the yield of that security, which is auctioned.
Well, Ted Carey's not bald. He's got hair.
On the run as of today. So it's important to remember that essentially the on the run and the benchmark and the final settlement yield is all based on the end of month snapshot.
I got
and that snapshot too, just to share a bit more information on that too, is powered by 15-minute volume-weighted average price of activity done on the BrokerTech platform, which is the leading platform for trading of treasury securities. David, go ahead.
Ted, I had a question, kind of a follow-up point to that question. Is at what point in and let's use the August as an example with the 10-year note, when does the soon-to-be auctioned 10-year become the measurement of the August futures contract at the point of it's trading as a WI? When does it actually become the current 10-year for measurement purposes of this contract?
Sure. So the benchmark itself changes on the day after the auction. If you think about the way the futures contracts work in general, is they're always designed to basically be the market's anticipation of where the market will end up at the end of the futures contract, right? So even though that auction hasn't taken place yet and the benchmark itself hasn't cut over to the new CUSIP, the market should anticipate that the auction will occur and price that contract accordingly.
But this contract will begin to price the 10-year once it's officially auctioned, correct?
Right.
Okay, thank you.
So we got another question, Ted, and the submitter kind of answered it themselves by saying or no because of the complexities. But they asked if there's going to be a spread between the existing Treasury futures and the new micro yield futures, and I think there's obviously some fixed income math that make that a little difficult. But I guess what's the official?
But you could do it.
Yeah, we're not planning to list any spreads between the micro yield futures.
They wouldn't list it, but you probably could still try and spread it.
Or use auto spreader technologies, but it's not something that makes sense to list an exchange to find spread at this time.
And what else?
Basically, you would be able to make a trade on the basis.
I'll put Ted on the spot a little bit. The question we get when we talk about all of our new micro futures is, are we going to have options on them?
We would love to add options, but in general, we usually need to reach some critical mass of liquidity in the futures first before we're able to successfully introduce options. So I'd say as soon as we get, the daily volume and open interest to a reasonable place, then we would love to add options as well.
We got a question on tickers. I'm not sure if were those on one of those slides that we had, or do we know what they are?
Probably.
On the contract specs slide.
Yeah, go back a couple more.
Oh, they did.
15. Yeah, so it's
2YY.
easy to remember. You almost can miss them in here, but it's essentially, for example, the 2-year yield is 2YY, 5-year yield 5YY, and then 10-year and 30-year are just 10Y and 30.
Because you have to have 3 symbols. I gotcha. So we're going to call them the Ys.
Question just now, kind of a technical question about whether or not the implied yields on the futures will differ from the cash on the runs.
Correct.
Yes.
I think is a question worth answering.
Yeah, I would say it certainly is possible. Like, futures definitely can have some, unique differences due to sort of supply and demand differences, somewhat similar to how, let's say, the price of a crude futures.
Cheapest to deliver can be different from the on the run, and there can be a small difference.
Roll that gets baked into.
If you go to the tool, it shows you.
Because the expiries only go out around 30 to 60 days, it shouldn't be a fairly large amount.
And that's just a basic tenet of all futures contracts, really, is that basis between, the cash and the futures. So, Ted, just real quick, we had a question on historical prices. I know you pointed me recently to the same website I think that Dave used to generate some of his graphs. It's not going to give intraday prices for these tenors, but would provide kind of a data close to close historical price of where these 4 tenors have been over the last, I think, quite some time. I know it was at least a decade. I look back.
Yeah, that's right. And you can also, broadly recognize that these are.
Good morning, Alex. How are you?
Treasury market, and I think on one of the very first slides Dave had at the beginning, maybe you can back up.
Coming in late. We're going to be shutting down here soon.
9 or so.
As soon as they finish this.
The chart that showed that from the St. Louis Fed, the Fred database, they publish yields going back. In this case, I think these charts could go back as far as 1970s if you want. So it's certainly possible. Now, this isn't the exact benchmark that's used to settle the product, but it should be very representative of the way the contract would perform.
So given these launch, and I'm not sure that we even said the specific date, which I think is another oversight on my part. It's Monday, August 6th.
Oh, you woke up too late?
Is that the Monday?
Hey, you missed some interesting action in the E-mini.
Sunday night, the 15th for trade date, the 16th. So since they launch on that day, we have a question. Would the first 2 contract months listed be the August and the September expirations, or September and October?
It's going to be the August and Sep. So we're going to list basically the one that expires on August 31st, then the one that expires on September 30th. And then once August rolls off the board, I think Labor Day comes around, and then we'll list the October.
Great. And there was a question on, is there somewhere to, and maybe this is a David question, somewhere to view the when issued prices if you're really getting into the details of this contract?
I don't think so. That's the WIs trade in the primary market, which is a rather a closed marketplace because it's primarily traded between primary dealers. I don't know if that information is even available to the broad general public. The securities become available once they've been auctioned, but the when issue process is usually an inter-primary dealer market, unless Ted has some other information. I don't know.
Oh, you bought the NinjaTrader license this last weekend, and they said, right. Okay, so
is that there will be a marketplace to view.
You can still use Rhythmic if you are at NinjaTrader brokerage.
A transparent data source.
Who's your broker going to be?
As to where the when issue is expected to price.
That's a great point, Ted. Another ancillary benefit of listing these products. So I guess finally, I know we talked, there's not going to be listed spreads against the existing treasuries. Are we going to offer margin offsets on them?
Yes. In general, we will try to offer.
Oh, you use TD.
Product that is highly that people might spread them against. So again, I don't know that we have the specific numbers there yet, but
there is a data feed for TD, isn't there?
Great. I think we're about out of time, and I think block trades, Ted, are these blockable?
Yeah.
They will be block eligible, just like every other.
I think you can connect to TD Ameritrade.
Great. Like I said, I think we're about out of time. I'd again like to thank everybody for tuning in. We think this is an exciting new product. It's a little bit different than the micros that we've launched to date. It's like I said at the onset, I think we've right-sized it for individual traders and also streamlined the product. So we're excited about it. Again, thanks to everybody for tuning in. And of course, thanks to both David and Ted for lending their expertise this morning. And we'll see you, I think, at the next webinar.
Thank you all very much.
Okay.
Good luck.
Thanks, everybody.
I'm going to shut that down. Okay, so here's what I would do, Alex, is if it was me, I would just start a NinjaTrader brokerage account. Like I would go and get, $500 or whatever the minimum is, and just open a minimum account with them, just so I can get the data at least or whatever. Because you're going to get better commissions and everything through NinjaTrader brokerage compared to TD Ameritrade on trading futures anyways. But I do believe it is possible if you come in here into your control center and you go to connections, configure, and there is a TD Ameritrade source. So I think you can use that. But you are correct that you can't use Rhythmic for the standard one. So like if you're using the demo, then you can use regular Rhythmic and CQG. But if you're using, your paid version, you can only use Rhythmic for NinjaTrader brokerage. There's like a Rhythmic source and there's a Rhythmic for NinjaTrader brokerage. So it is possible to get Rhythmic for NinjaTrader brokerage. My understanding though is that it's kind of iffy as to whether or not you can switch over at the current time because they're still in the process of switching over to being an FXCM. So I'm still running on CQG because when I asked them, they said it wasn't available yet. Maybe it is available because I understand that new accounts are being created on the NinjaTrader FXCM. I'm still on Phillips, and I don't know when they switch me over or how that works, but so that's the long and short of it. Does it make sense? So I think that gives you everything that I know about it. Anyways, I'm past my time, so I am going to change the title here really quick to CME Micro Treasury Yield Webinar Watch Party. That's what we did. And I'll see you guys tomorrow. In the meantime, stay profitable, friends.